All right, thanks for everyone for joining us today on our webinar, and thank you for those of you who are here right now for being here on time. We will wait about one more minute because we do want to start promptly. So take this minute to um, do whatever you need to do to get comfortable for the next 30, 40 minutes or so, and then we'll get started. All right. We will go ahead and get started now. So today's webinar is Investing Beyond Multifamily, How Hotel Investments Outperform Everything Else in 2026. And our presenter today is Raza Khan. I'll let Raza tell you more about himself, about Qila Capital in a moment. As always, we have our disclosure. So this is a reminder to those of you who have watched these webinars before and those of you who are new to the webinar that this is for informational and educational purposes only. Camaplan is not an advisor. So if you're going to make any decisions related to investments or things that will impact your taxes, please do your due diligence and seek out the advice from the appropriate professionals. Also, if you want to learn anything about self-directed IRAs, understand how those work, or if you have a question that gets missed on today's webinar, feel free to reach out to me directly. You can use my email or direct line there, and you can always use the QR code to schedule a call with me. We do a lot of hand holding in the self-directed IRA world, so if you're curious to know just about how to get started with a specific account type or you're brand new, please don't hesitate to reach out. So with that, I will stop sharing my screen and turn it over to you, Raza.
Thank you very much, Matt. Before we begin, just a quick audio check. Can you hear me okay?
Yep, crystal clear.
Perfect. Thank you very much for having me. Very excited to be here with everyone today. Thank you very, very much for joining. I'm guessing our topic was intriguing enough, and that's why people signed up. So we love sharing our story. We love talking about what we're doing and how investors can benefit. So very happy to be here. I'm going to be making a couple of bold claims today because I think that's the best way to stir the pot and get people thinking. Um, and if you have any questions, please save your questions till the end and ask as many questions as you like because I like to share and make
I'm going to
everybody comfortable.
interrupt you for a second. Sorry, Raza.
Yeah.
Great segue that Raza mentioned about questions. The chat will be turned off during the webinar, but our Q&A function will be on. So please, all those questions that you're going to ask after the provocative claims, please make sure you ask them in the Q&A, and I'll monitor them and save them till the end to ask Raza.
I will start sharing my screen.
Great.
Okay, and then we will kick it off. Can everybody hear me, see me, and see the screen okay? If you can just raise your hand, that'd be fantastic.
Looks good. Yep.
Perfect. All right. Well, here we are. So today's topic is investing beyond multifamily and why hotel or hospitality is the best asset class in 2026. My name is Raza Khan. I am the Chief Investment Officer at Qila Capital. And as you know, a lot of us we love to give disclaimers, just like Matt did a few minutes ago. So this is our disclaimer that we are a 506c company, pursuant to the SEC, and we work with accredited investors solely. Everything that I'm talking about today is educational, and it's my opinion. And opinions are like, you know what? Everybody has one. So take that with a grain of salt. All right. Happy to be here. So my agenda is I'm going to talk for about 30 minutes. I'm going to talk about commercial real estate. I'm going to talk about what makes a sweet deal and really what makes the, 1% of investors different. And lastly, I'm going to give you a little takeaway to take home with you and think about. We're going through a lot of changes in the world right now, and the war and all the disruption that's happening with the technology today. I want you to think about what that post-disruption world is going to look like. We believe that our asset class truly benefits from that, and we'll talk about that towards the end as well. And then towards the end, we'll open the floor to questions. So who are we? We are Qila Capital. We're a Texas-based private equity group. We have about $235 million in assets under management. That number fluctuates, obviously, when it comes to asset valuation and acquisitions. We've been expanding rapidly. Um, so we specialize in two different asset classes. One of them is healthcare, and the other is hospitality. Today, we're talking about hospitality because we don't really have any active opportunities in healthcare. And we'll tell you a little bit about what we do as well on the healthcare side, just to plant a seed. Our philosophy is that our investors should earn more and live better. Really, we claim to bring the best of both worlds together, profitability and lifestyle, which you'll hear about later. A couple of things that make us unique. We provide, a lot of value. We aim to enhance how investors access alternative investments. We charge no fees of any kind, no acquisition fees, no management fees. And our philosophy is that every deal that we bring should cash flow. If it doesn't cash flow, it's not a great deal necessarily. Okay. Um, so here are my bold claims today. Number one, and what is it I'm claiming? I'm claiming that branded hotels win in 2026 over everything else, especially multifamily and other deals that are out there like construction, new development, etc. Hotels are more profitable. Okay, they generate a higher cap rate than any other asset class. I'm sure you've sat through a bunch of webinars before, and you've heard that this term being tossed around, cap rates. We'll talk about that in a little bit, just a little bit. We'll touch on it. Multifamily and industrial cap rates have been compressed. Hospitality offers better spreads and more value add because hotels are businesses. They're not typical real estate. Number two, it's one of the only investments that combines high returns with a great lifestyle. When you bring the best of both worlds together, a good yield and a good lifestyle, that's a life well lived, right? And I think that's everybody's goal here, to work less, travel more, and not deal with property management nightmares and things like that. And our asset class truly makes that possible. And we'll talk about that in a second. And secondly, to add to that point, pride of ownership. With branded hotels, we get to partner with brands like Marriott and Hilton and Hyatt and IHG. And the pride of ownership that we get and our investors experience is unparalleled. Last but not least, it's backed by real demand by the end users and investors. People are traveling more than ever. As you know, there are budget airlines now that you can fly across the nation for 30 bucks. I've done that, by the way. I did take a flight one time from Orlando, Florida to Los Angeles with a budget airline a long time ago. But the point is, it's possible. And because people move, they need a place to stay. And that's where we come in. People are traveling more than ever because of the work from home concept. And now there's a new phenomenon known as bleisure or business leisure, where people are traveling, but they're working, they have their laptop with them. The wife is in the spa downstairs, the kids are in the pool, and the dad is in the room answering a couple of emails, and he joins them later for lunch. This is a very common trend that we're noticing now. Second thing, people are coming back to hotels and ditching Airbnb, and I hear about it all the time. We have a lot of investors that did short-term rentals on their own, or they stayed at short-term rentals. As a whole, the trend is shifting back towards hotels, which is great. The hospitality market has adapted, and brought in more experiences, more wellness options, et cetera, et cetera. And again, like I said, what does the post AI world look like? I know you've heard about this a million times, so I'm not gonna talk about AI in this presentation because even I'm sick of it. Everybody's talking about it. But what does that world look like when people are traveling more, they're working less, they're making more money? Because AI really is going to be a tool that helps us leverage our time better and our resources better, right? So that's something I think about. What does that look like in the next 5, 10 years? And last but not least, we all know private equity is taking over America. They're buying anything from HVAC businesses to septic tank cleaning companies, for example. They're buying anything and everything. So this is still one of the industries or asset classes that has not yet been taken over completely by all that Wall Street money. Um, because they're businesses. I mean, and they're underwritten like real estate. So this is a trend that's happening as well. And when more capital gets injected into any economy, you know what happens? Asset prices go up. So just a quick little primer, because this is an educational webinar, and you've probably sat through a bunch of presentations like this, and you may not be a professional investor. You are someone that has a nest egg sitting in your retirement account. You just want to learn how to leverage it more and what options are available to you. So this is a sort of a high level primer on the different types of real estate that are out there. So number one, I am getting a message here. I just want to check. Is there a message to me? I am unable to see it. I saw a couple of Anyway, Matt will tell me if there's something,
Yeah,
right, Matt?
that was just me sending a chat to everyone to ask their questions, so you can ignore
Cool,
that one.
cool, cool. Awesome, awesome. Thank you. Um, so you have residential real estate, you have commercial real estate. Residential is anything that's less than 4 units in a house. Anything more than four becomes commercial, and everything else is also commercial. So you have retail, strip plazas, you have office buildings, you have industrial, you have hospitality, you have medical, multifamily. Everybody talks about multifamily. It's the most saturated asset class in the country. We don't hate multifamily, but we just think it's very mediocre. And oversaturated, mediocre, there are better options out there. And that's how we got into the hospitality business because there's more money to be made. And then there are some types of real estate that are hybrid models that require a little bit more operational expertise and time and energy and elbow grease, but they're disguised as real estate. And you can think of a bunch of examples in your head probably right now as I speak. Car washes are a great example, gas stations, laundromats, hotels. These are underwritten like real estate, but they're businesses. But so the advantage to that is if you are someone willing to roll up your sleeves and get to work, this is something you can extract more money out of, more cash flow out of. And of course, as you may know, in real estate or in any sort of investment, there's a direct relationship between the income of the asset and the value because as the income goes up, the value goes up. And that's what all the multifamily guys talk about, how we're gonna raise the rents and then it's gonna be worth more later. So this is the advantage that if you're a good operator, you know what you're doing, you can make more money typically. Okay. This is just a high level snapshot of what the yields look like or what the cap rate looks like in every sort of asset class. Okay, this is a historic. I believe I got this from one of the big commercial real estate brokers, Marcus and Millichap or CBRE from their data department. These are all the typical assets that are available to investors. And as you can see, that hotels typically perform better than a lot of other options, residential, industrial, office, retail. That's what you have to take away. And naturally, because more work is required, right? You're managing a team of people. In one of our hotels, and it blew my mind even. It's a select service property. We have over 45 employees at this 136 room hotel. And that means there are people calling in sick, there are people going on maternity leaves, bereavement leaves, etc. Supplies are coming in and out of the property, food, soap, laundry detergents, etc. So the more work is required, the more money you can make, which is natural. So I don't want to talk too much about this. I just touched on it. Passive versus active real estate, right? A lot of guys out there, a lot of fund managers out there are typically involved in passive. They want to make money off of, they want to build equity, but they don't want to do too much work, right? In our case, we're in a business that requires operational excellence. And if we don't work hard, if our properties don't perform, then they don't make money. And then the investors don't make money. So this is the business we're in. The trade-off is active assets like hotels require expert operators to extract value, but they offer significantly higher recession-resistant cash flow. This is not always the case. It is a case in our experience because our properties are always backed by secondary demand drivers. And we'll talk about that a little bit later as well. Some more data. So I don't want to talk too much about this because it may sound a little boring or redundant, but there is a great opportunity in the market right now because of what's happening in the world of commercial mortgages. During COVID, a lot of people originated loans. They either bought new properties or they refinanced properties at really low interest rates. And now those rates have gone up significantly and the mortgages are coming up for renewal. But in commercial real estate, there's a special program called CMBS program, Commercial Mortgage-Backed Security Loans. And these loans do not require a personal guarantee. That's something you need to take away. So what happens? And by the way, this is the only country, America is the only country that does this, I believe. I know out of all the other G7 economies like Australia, Canada, the UK, I don't believe they have a similar program. Here, this program or this CMBS program allows you to buy a property without a personal guarantee based on the asset itself. So if one day the rates go up too much and you just don't want to deal with it, the bank can take it back and there is no recourse. They can't come after you. So that's what's happening right now because there's so much debt that is coming up for renewal, especially in the institutional grade properties like hotels, big apartment complexes, etc. The owners are just giving the keys back to the banks and saying, "Here you go. This is your problem now. God bless you," and they walk away. And the banks are not in the business of operating, right? They're in the business of lending money and getting deposits. So if they have bad debts on their books, it doesn't look good on them. Their share prices go down. They don't like that. So they like to clear these bad debts off their books as fast as possible. And that is where people like us come in, asset owners or asset operators or private equity guys. We come in and we buy these hotels and we take advantage of the market timing because timing is everything. So this is the delinquency rate of the CMBS and what's happening with that. Okay. Moving on, let's talk about what makes a good deal in our business. Okay. And we're going to talk about the opportunity a little bit later. This is just thought-provoking stuff. What makes a good deal? The location, of course, not just what street it's located on, but is it taking advantage of regional drivers or local demand drivers? For example, we're located in San Antonio, Texas. We have five hotels, six. We have six hotels in total at the moment. We have a bunch more. We have two under construction. We have one more in the pipeline that we're about to acquire by the end of the summer. Um, so out of the six hotels, we have three hotels in San Antonio. Oh, sorry, four hotels in San Antonio. Each one of them is backed by a demand driver. For example, one of them is at the San Antonio airport, a mile and a half away. So we're not dependent on just tourism. Anytime there's bad weather, At that, and it happens a lot during the summer in Texas, by the way, a lot of storms. So because there's a UPS crew that's operating out of the airport, the UPS, the company, their pilots stay at our hotel, for example. So we're always hedging our bets and always covering ourselves and protecting the downside by having a demand driver backing the property. So in this example, there's the airport. Another example is one of our properties is located right next to Lackland Air Base, which is one of the primary basic training facilities for the Air Force. So parents are always coming there to see their kids. Sometimes we have our troops staying at the property as well. That's one example. I can talk more about this, but you get the point. Always cover, yourself and the risk. So that's number two, demand drivers. Number three, geographical trends. Are people moving to Texas or Florida? I think they are. I think there's a big migration trend. People are moving from California to South Texas and Austin. There are people moving from even New York to Dallas now because, they just launched the Texas Stock Exchange in Dallas. So, and then there are other unique things happening only in Texas. For example, Elon Musk SpaceX is building a purpose-built space city, the first city in America or probably in the world built for space travel, and it's called Starbase Texas, and it's next to a city called Brownsville, which is we're doing something there as well. So follow the trends, which is great. And last but not least, market conditions. I mean, I just told you what's happening with the interest rates. There's a relationship between the interest rates and the cap rate, or how much someone or an investor is willing to pay for a property. When the interest rates are really high, the bank rate, I mean, the Fed rate, when the Fed rate is high, it's more expensive to borrow money, so people are willing to pay less for the property. When the Fed rate drops, people are, lining up to the bank to raise money. We're not entirely dependent on that because our business, the hotel business, benefits from cash flow, benefits from people checking in and out, and all these other trends. So that's why I put it at the bottom, really, because we can make money when the market is tough and when the market is great. As long as people are traveling and moving around and people are staying at hotels. Let's talk about this part, how to invest like the 1%, right? This is a topic that intrigues me because I talk to a lot of investors. My father was a physician. I have a lot of physician uncles and, et cetera, friends and family. And so one trend that I have noticed is the ultra successful people, the ultra successful investors, they stay in their lane. Obviously, they focus on their bread and butter, what they're good at, whatever your 9 to 5 is, however you put food on the table, your main or income generator, you focus on that. Number one. Number two, invest in what you know. And this is a quote by many people, Peter Lynch, Warren Buffett. They say all the greatest investors have always said the same thing. Invest in what you know and understand and stay away from the hype or the shiny objects that pop up in the market all the time. Uh, and then secondly, the 1% or the ultra successful investors, they try to get the best of both worlds. They want to profit like an active business, but they want the stress-free, no strings attached, no responsibility that comes with active business management. So they want to earn passive income, but the income should be high enough that if it's not, it shouldn't feel like passive income. It should feel like active income. Um, and then this part I touched on already that they don't try to be experts in everything. They partner with experts or with the people that are good at what they do. The art of operating value isn't just found, it's extracted through hard work, through management, through market positioning, geographical timing. We do this all the time. And there are a few slides which I'll share with you momentarily. And then this part right here, investing in the future. We're going through a lot of big changes very fast. There's another webinar that I did not too long ago on my own with our own audience at Qila Capital. And I talked about how many crazy events have happened in the last 50 years, for example? How many wars have happened? The Great Recession of 2008, the crash, the pandemic, this Iran war, for example, and now we have AI. So there's so much happening, and the amount of time that, it used to be spread across, but it feels like it's happening a lot more frequently than it used to. So what does that post-disruption world look like? And last but not least, contributing to something good versus something bad. A lot of businesses, some people don't have a conscience when it comes to profit. I believe that the two should coexist. Um, we want to be a part of something great. Like hospitality is great. People are happy. People are traveling, they're going to Disneyland with their family, for example. All kinds of things. Versus some asset classes like multifamily, they're profiting off of this crisis that's happening. The fact that we're not creating homeowners anymore, we're creating renters for life, and that's where the trend is going. That everything is going to be leased at some point. Home ownership is declining, etc. So we want to do the opposite. We want our investors to participate in things that they could not normally participate in because the barrier to entry is high. Buying a hotel is not cheap. It's the cheapest hotel you can buy is like $15 million, a decent one, a branded one. So, anyway, something to think about. What makes us unique? We don't want to talk too much about ourselves. We want to hear questions from you, and of course, we can connect for another call if you like this presentation and you like what you hear. What makes us unique? We have a proven track record. Actually, I forgot to update this number because we're expanding so fast. I apologize. We have over 230 million in assets under management. Okay. Our strategy is cash flow first. Okay. Um, the asset should perform and extract and pay a dividend very regularly. And our goal is to give our investors a distribution in the first quarter after they sign up, like right away. They should be expecting a prorated distribution in the same quarter. Number three, compliant and democratized. We are making unique and alternative investments more accessible to investors without any BS, no fees of any kind, and double dipping, and it's a partnership model. And there are other benefits to this, which I'll talk about as well, the lifestyle benefits. And last but not least, earn more and live better. We are one of the few companies that does this. Our investments are highly competitive when it comes to the distributions, and we pass on some of the hotel ownership benefits to our investors that they can enjoy. This is what our leadership team looks like. People often ask, why do we have a doctor, a chief medical officer? Because more than half of our portfolio is in healthcare, and I'll talk about that in a second. Kuldeep Gyani, he's our CEO. Dr. Pareen Shah, he's our chief medical officer. He oversees the healthcare portfolio, and then myself. And I do look a lot better in that picture, I must admit, than I do in real life, in case you're wondering. We're not going to talk too much about this, the bios. I'll send the deck to Matt, and Matt, you can share with all the attendees as well. So half of our portfolio, like I said, is in healthcare, and the other half is in hospitality, but the hospitality portfolio is growing really fast. Um, we primarily focus on in the South Texas region, so San Antonio, around San Antonio, and south. So these are tertiary markets. The tertiary markets perform better than the main markets that everybody flocks to. Dallas, Austin, Houston, these are overrated. Dallas is a great market in my opinion, but Houston and Austin is overrated. San Antonio just became the sixth largest city in the nation. People don't know that. We have the most visited landmark in the state of Texas, which is the Riverwalk. We have the Alamo, and now we have the Spurs for all the basketball fans. And the Spurs are going to draw a lot of tourism. I know they just lost, but it's a young team, and we're betting on the fact that this is going to be a legacy team that's going to win for a long time. So we have, like I said, multiple hotels, and we're also very active on the healthcare side. We have two freestanding emergency rooms that we own and operate in South Texas, in Laredo and McAllen. Not just the real estate, we actually own the medical practice for each. So they're highly, highly profitable. It's crazy how well they do actually, and people don't believe us. But we're expanding our healthcare portfolio as well. We have a micro hospital coming up in Brownsville, which we're very excited about. And we have this brand, Optimal Wellness and Recovery, which we're expanding as well. This is what our hospitality portfolio looks like at the moment. We have a Staybridge Suites in Laredo, and this is one of our best performing properties, over 95% average occupancy. We have a contract with the National Guard. They take 70 rooms in this property, and they take 50 rooms in this property right here, the extended stay hotel. This property is undergoing a conversion to a Hyatt Studios, which is one of the new Hyatt select service brands. We have two Aloft brands. These are also Marriott properties. And the Aloft is a very nice, hip, young, a millennial brand, as some people like to call it. And it's like a budget version of the W. We love it. We have a courtyard. This is the one that's located by the Lackland Air Force Base. And this is our newest acquisition that we just completed last week. This is a Town Place Suites. Beautiful property, by the way. It's a historic building and it was converted to a hotel. And this one's at the Riverwalk. Mainly, this is the most tourist property that we currently own. This is what the healthcare portfolio looks like. And by the way, just to go back one more time on the hospitality side, we are in the midst of our most exciting acquisition to date, which is the Westin Hotel. It's our first full service property. We're very excited about it, and we'll talk about that later. Is everything okay, Matt? The sound and the
Crystal
connection?
clear. Yeah, we have some questions
Perfect.
coming in, but I know you wanted to wait till the end, so I
Yeah,
think it
yeah.
sounds like we're kind of getting to that point. But yeah,
Correct.
this is great.
Correct. These are some of the healthcare assets that we have. We have two freestanding ERs, and these are fantastic. Just this freestanding emergency room, believe it or not, generates over $22 million in EBITDA a year. So absolute winner, And then we have the McAllen emergency room, and then this is the micro hospital that we're building in Brownsville. We have a hospice company in South Texas. We have a medical equipment company, and then we have this Optimal. So people often ask, "Hey, how can we invest in the healthcare stuff?" We are trying. It's a lot more regulated because we're not just investing in real estate when we're investing in the medical practice. We're acquiring and operating. So we are working on it, and we will have something by the end of the year, hopefully, in this regard. Our first healthcare fund. So I talked about Texas. I talked about San Antonio. Let's jump into what kind of investments we have. So we have two types of investments. We have the debt investments, which is basically a mezzanine debt fund. It's called the Hotel Cash Flow Fund. And then we have private equity placement options on a deal by deal basis. Of course, you're eligible to invest in both with your IRA, but the equity investments are typically they generate a higher return, but the minimum investment is also higher. But the debt one, the mezzanine debt fund is a very, very, very flexible offering, and we designed it with the average investor in mind that is not too sophisticated, wants to test the world of hotels. They want a low commitment option where they can invest a little bit of money and see how it performs. And this is what this is, and I can talk about it momentarily. But the mezzanine debt fund is a portfolio of three properties, three existing hotels that we own, and the equity option is on a deal by deal basis. And we have a couple of options, active options right now. That's why I placed this IRR. I know this sounds crazy, the 41%, but it is true. And this is a deal that we're acquiring, the Westin Hotel. So let's jump into a quick summary of the mezzanine debt fund, the Hotel Cash Flow Fund. So the Hotel Cash Flow Fund is, like I said, our mezzanine debt fund. This is a portfolio of three properties. Two of them are Marriott's. One is an IHG. They're all located in Texas, in South Texas. Two of them are in San Antonio. One of them is in Laredo. The combined revenue of the portfolio is $12 million. Dollars. The combined net operating income as of now is 7.2 million, but obviously these are being stabilized and they're going to perform a lot better. But the numbers are still really, really strong right now. And total value of the portfolio is about 56 million, and there's almost 39-40 million dollars of equity in the portfolio. So one of our hotels, the Staybridge, has no debt on it, no bank debt. So we're very risk averse. We are very conservative people, and our underwriting is always very conservative, and we're also very well funded just because we have a healthcare portfolio that does so well. So this is something that's worth mentioning, not to brag, but just to let everybody know that we're not doing this, just to make money. We're doing this for a bigger purpose and a bigger vision. This is a high level summary of what the returns look like for the hotel cash flow fund, the mezzanine debt fund. We have two share classes, but really at this point, the second share class A2, it makes no sense for anybody to invest in at this point because at this point you have other options available to you, the equity options which perform way better. But it's a 3 to 5 year commitment in terms of timelines. 50,000 minimum investment, and there are distributions that are paid. There's an 8% fixed return, which is paid on a quarterly basis, and there is a an annual performance bonus of about 5%. Now, I do want to mention, because this is an IRA focused webinar, um, we do have some other lifestyle benefits which we offer our investors, but the our ability to um, offer that for IRA investors, it is possible, but we just have to talk about it in a call, basically, and figure out a way to accommodate that. But just because there are certain IRA rules, am I right, Matt?
You're right. And I think, this is a group of folks who have IRAs with Camo Plan, but they don't invest solely from their IRA. So, um, you can discuss those as much as you want, and just
Sure,
I think I wouldn't want to withhold information for folks if
sure.
they want to invest outside of their IRA.
Sure. Yeah, and I'm just gonna say with the caveat that this presentation is this part is generic, and I'm talking as a sponsor. Uh, and if you decide to invest with your IRA, that's a separate conversation. So that's what the returns look like. The target IRR is about 13%. And actually, this is the actual IRR, not the adjusted IRR. And then investors that invest $100,000 or more get access to Marriott discounts. And I know this is a crazy thing, and it's going to blow your mind. Uh, People love it. Our investors love it. We are not a timeshare company or a vacation club or anything like that. We are a proper fund that invests in hotels. But because we're investing in hotels, there are certain benefits and privileges and perks, you could say, that hotel investors and hotel owners get. So we figured out a way to pass on some of those perks to our investors. And effectively, you get a discount. There are various discount codes, special codes, and using those codes, you could save anywhere from 50 to 70% off over 10,000 Marriott Bonvoy properties around the world. And you heard me right, and I'm going to show you an example towards the end of how amazing this is. This is a sample equity deal. So this is one of the active deals that we have available at the moment. This is an Aloft, the Aloft that we own. We acquired it in November 2025. This is a property. It's an amazing story. And just to tell you what our strategy is, I didn't talk too much about our strategy, but let me touch on that actually. It's a good point, and I'll try to cover it in 30 seconds. Um, what I talked about earlier about all the distressed debt out there, our strategy is to take advantage of that as buyers. So we don't build anything. We're not developers. We do have a couple of projects in the pipeline that we're building for ourselves just because we have contracts secured with the National Guard. Otherwise, we would never do new construction because it's way too expensive. Um, Our strategy is we buy hotels for 60 cents to 70 cents on the dollar, especially based on their replacement value. This is a property, for example. This is an Aloft hotel located right next to University of Texas in San Antonio, UTSA. And this property was built during COVID in 2021, and it cost the developer between 25 and $26 million to build. And then they completed, they launched in fall 2021. In 2022, they went under contract to sell this property for $29 million. We all know what happened in 2022. The rates went up, the Fed rate, the market completely panicked. The lender pulled their financing from the buyer backed out, the property sat and got distressed. All during that time, this is a new hotel and it's still ramping up. People are checking it out and staying at the property and excited about it and whatnot. But we just bought it in November 2025 for $17 million. Okay.
Wow.
So 20 from 29 million to 17 million dollars. And that is a strategy. Hit a home run with the buy because when you buy right, you make money right away. You have instant equity baked in, and that's what we're doing. So this is a sorry for that you know, I just went off course there for a moment. But coming back to this, this is a sample equity deal. We purchased it. It needs nothing, okay? It doesn't need any upgrades or anything because it's a brand new property. The only thing it needs is steam cleaning the carpets. And when I was there last time, I saw the carpets were missing from the lobby because they're being cleaned and treated. So there you go. That's the only thing that was needed. Um, what we did is we bought this property for 17, closing costs, franchise fees. Of course, the value has gone up significantly of the property since we bought it because it's performing way better. But as of now, if any investors buy in, they're not getting they're buying in for a value of 17.5 million, which is very insignificant, increase. And what we're doing is we're paying down the note. So we have a 70% loan to value mortgage on this property with a regional bank. We're going to pay it down. We're raising about 9.3 million. We've already raised a lot of money, like I would say half. So we do have allocations available in this. If any investors are interested, there are two share classes with this option, A1 and A2. A2 is 300,000. That's where it starts. And then A1 is 500,000 or more. So if you're investing $500,000 or more, you get a slightly better distribution. You get a 10% preferred distribution versus a 9% preferred distribution. And then there's an equity uplift that's projected, based on what the value is going to be of the property. We believe this property is going to be worth north of $27 million, 28, close to $30 million in 5 years. As the rates taper off and the property performs better, and because we bought it for so cheap, practically stole it. So we think we can deliver an IRR between 19 to 25%, depending on the share class and how much the investor is investing. Okay. This is the structure of what an investment looks like. Because we're a 506c company, we're regulated by the SEC. All of our investments have to go through our fund, our 506c fund. And your ownership in the hotel is tied to the hotel through the fund through a lower tier entity. And this is a very legal and compliant way of doing it. And it accomplishes the same thing. And we have an investment portal. You get it that you use to access your investment online. Every year you get a K1, obviously, during tax season, and you get regular reports on how the asset is performing. And now this is the fun part. Let's talk about this. I think we've talked about all the boring stuff, the numbers and stuff. This is the fun part. So the Marriott family of hotels includes all of these properties that you may or may not know of. Different categories, obviously. You have the extended stay hotels, like this Town Place Suites that we just bought. This is designed for people that are in town for business or whatever, and they just need a place to stay for a couple of weeks. They're working on a project or they're, being deployed or whatever. Then we have the select service brands, which are your budget brands. You already know a lot of these, Courtyard, Aloft, Four Points, Fairfield, etc. Then you have the premium brands. And we are very, very excited and very delighted to announce that we're acquiring our first premium property, which is the Westin in San Antonio. That property has significant upside because it's 326 rooms and we're picking it up for $55,000 a key. And the replacement cost to build a hotel like that new today is between 350,000 to $500,000 easily because it has all these amenities like a convention center and restaurants, bars, cafes, etc. We're buying it for cheap. It needs a huge upgrade. It needs a $15 million upgrade. So 18 million plus 15 million, it's a $33 million. But we believe that hotel is going to be worth $90 million in a few years once we've done the renovations and all that stuff. And right now it's generating $80 a night. That's how much it costs to rent a room at this Westin. When was the last time you stayed at a premium property for 80 bucks? Westins typically rent for 249, $300 a night. And that's what we're aiming for. We're going to upgrade the property, enhance the rooms, and then people are going to pay a premium. So why am I telling you all this? Because if you invest with us, you get access to this discount. There are certain codes in the MMP, sorry, in the Marriott Bonvoy family of hotels. Investors that invest 100,000 or more get access to the MMF code, which is a friends and family, Marriott friends and family code. Investors that invest 250,000 or more get access to the MMP code, which is the most coveted discount in the world of hotels. Okay, and I'm going to show you some examples of what that discount looks like. These were done last year, by the way, September 2025. This is the Ritz-Carlton Laguna Niguel in Orange County, California. Beautiful, beautiful property, overlooking the Pacific Ocean, lovely place. $172 a night. With the discount, it's $281 a night. And this is real. These are real. This was taken on my iPhone on the Bonvoy app. Okay. This is the W Hotel in Times Square, $453 a night. With the discount, $257 a night. This is the Marriott County Hall in London. County Hall, that's the name of the area. 613 pounds a night. With the discount, 133 pounds a night. Okay. This is a testimonial and I had his permission. So we have an investor. He is a young guy, founder, sold his tech company at a young age, still in his 20s, travels a lot. He invested particularly for the discount. And he sent me a screenshot from Switzerland. He was at a ski trip and he saved almost $1,000 a night staying at the Ritz-Carlton because it was 1,400 a night or something, and he paid 360 or 370, 380, something like that. So saved a lot of money. And that is basically, and that's exactly that's the hotel he was staying at in Geneva, 1,400, 363. So that is basically a high level summary, and that concludes my presentation. I hope you guys have a lot of questions, and I hope you enjoyed it because I hope it was unique. It's not the same boring message you hear all the time. Um,
No, that
yes,
was great. Some of these questions you did ask, but I'll ask them
sure.
anyway just for you to
Please.
kind of double down on them.
Sure.
So, first one was large hotel brands offer luxury and budget-friendly hotel classes. Which hotel class has Qila Capital invested in? Is there one that is historically more profitable and cash flowing than the other?
Correct. Yes. So we typically invest in select service properties, the budget properties, because they perform way better. They're way more profitable than full service properties. We're doing this full service acquisition now at the Westin for the Westin, and this property, we're only buying it because we're getting such a great deal, and it's a gem. It's a landmark property. It's a feather in the cap or a trophy property, and the basis is very low. But typically, select service properties are a lot more profitable because they don't have all the extra amenities like food and beverage and valet services and all these crazy expenses that pile up. I met an investor who worked at Marriott and he was interested in buying a hotel and he had lunch somehow at a corporate event. He met the CEO of Marriott, and the CEO of Marriott told him, "Hey, if you ever buy a hotel, just remember, if you want to impress a girl, buy a full service hotel. If you want to make money, buy a select service hotel." And this is a quote that I'm quoting from secondhand sources, but I hope that answers your question. Two of our properties have performed very well historically, the Staybridge and that other property, the Hyatt conversion. because we have contracts with the military, and that's kind of our goal with all of our properties. We have this a loft at the airport, which we acquired in March 2026, a few months ago. This property has a contract with the airlines, with UPS, with this airline called Breeze. We are aggressively pursuing more contracts. So Air Canada just started a direct route from Toronto to San Antonio. So we're approaching Air Canada, we're approaching Delta, and we're always hedging our bets because I would rather have, or we would rather have, 20 rooms filled at a slightly discounted rate than them sitting empty, right? So hope that answers the question.
Perfect. Um, so these next two questions came from the same person. I'm going to ask his second question first. Will investments be used in a fund or a single site? You answered that with the debt fund, which is currently supporting three properties, or on
Correct.
the equity deals, which can be invested into individual sites.
Correct.
So the other question is, what will the investment capital be used for?
The investment capital, depending on the product, so the hotel cash flow fund is to effectively it's used for the same purpose, is to acquire more properties and expand our portfolio. The mezzanine debt fund is limited to three properties, but we're doing it in that way because it was the easiest way for us to create a product that investors wanted. So we created the mezzanine debt fund after talking with dozens of investors, and they all kept saying the same thing. They asked for three things. Number one, how can I invest in a portfolio versus a single property? Number two, how can I invest for a shorter term rather than a longer term? And number three, how can I get more cash flow today than a promise for gains tomorrow? So we thought that the mezzanine debt fund with our existing properties would be a great way to create comfort and easy hypothesis. And last but not least, and just to create liquidity and the same liquidity, we're using our own equity, that liquidity is being created against our own equity, and we can then use it for future acquisitions. The second one, obviously, the equity deals, we do it to just fuel acquisitions as well.
Excellent. And I think that's a great strategy that you have. One of our owners, Carl Fisher, always recommends to sponsors to have a debt fund in place because as people get older, their um, risk profile of investments changes, and for IRA investors, they're facing required minimum distributions, so they need cash flow. So
Yeah.
it's great that you have both options.
You know
Um,
what? One more thing, Matt, just
sure.
to just expand on that. Also, people have different appetites, and people like to build relationships. So we are relationship-based people as sponsors. We tell our investors, just work with us, start with something small, give us a chance, let us show you what we can do for you. And this mezzanine debt fund is a perfect way to build a relationship, and is designed to be a relationship builder that can change into something more substantial in the form of an equity investment later on.
Nice. Well said. Question was, can you explain the uplift bonus?
The uplift bonus is effectively a performance bonus. So we wanted to give more value to our investors than a typical debt fund. Like most debt funds will just give you a coupon payment and that's it. Like God bless you. We wanted to lower the, FOMO, fear of missing out. So we didn't want our investors to feel like they're missing out on gains. So we created a hybrid product that not only gives you the certainty of a fixed return, but it also allows you to enjoy some upside. But instead of the upside being you waiting for the upside for 3 years, you get the upside at the end of the year. How we fund that, to give you an honest answer, how we fund that, obviously there's a lot of margins. Like the fund is it's generating a lot of money, right? So we can pay performance bonuses. However, we want our investors to feel like we're effectively advancing them the upside, or we're letting them enjoy the upside with us, but they get paid at year end rather than waiting 3 years.
Beautiful. Just for my own knowledge, you mentioned earlier how you felt Austin and Houston were, you know, kind of oversaturated, overrated at this point. I think just for the benefit of for the folks on this call to sort of give them a little bit of some insight into your thoughts in that process just in general, can you kind of drill down a little bit more about why you like other areas of Texas versus Houston or Austin?
Absolutely. So I'm a firm believer that the tertiary markets are often way stronger than the primary markets. Austin became the favorite child of not just Texas, but America during COVID. It became this utopia where people from California fled with their money and they came to Austin. All of a sudden, you were able to buy a mansion for $500,000 versus $2 million in California. And all that hype created speculation. A bunch of, I mean, so many sponsors jumped into Austin for construction projects, multifamily operators, multifamily developers, and they went all into Austin. And then, but they did not have the the foresight to de-risk and hedge their bets. What if the economy turns around like it did? So to answer your question, um, Austin is going through a massive correction. At the same time, there's too much product and not enough demand. And there's nothing else really fueling that demand anymore. So whatever tech companies wanted to move there, they've already moved there. The people that came from California, their honeymoon is over. A lot of people are actually moving back to California, or they're moving to other cities within Texas. And Houston, and so to Austin has too much product, too many hotels, too much multifamily product. Same thing with Houston. Houston is a gigantic city, huge. I mean, it's so frustrating. No offense to anybody that lives in Houston, by the way. It takes 45 minutes to drive from one place to another. And there are a dozen Courtyard hotels in Houston, to give you an example. So there's so much inventory, and you can rent a room in Houston for like $60, $70 at a branded hotel. So um, we love the tertiary markets that have real demand. San Antonio is just became the sixth largest city. It's having 100 new residents moving here every day. The airport is undergoing a $2.5 billion expansion right now, SAT. It's one of the only airports that still feels like a tiny one terminal airport because it is. People don't know this. San Antonio is the largest military city in the country. It's actually known as Military City USA. There are five major military bases here. There's a lot of heritage, military heritage, and there's a lot of demand because of the military. So this is a slow burning, organic sort of a city, and it's expanding fast now. And we believe there's a lot of runway. And unlike other cities that have already gone through a growth cycle, this city has not yet gone through a growth cycle. I believe San Antonio is the second most affordable city in the country still.
Hmm.
That should tell you everything you need to know. And then other markets like Laredo, McAllen, South Texas. This is a difficult market to navigate for a lot of people because you have to be bilingual. You have to speak Spanish to survive. We do very well in that department because my partner grew up in Laredo. He knows that market like the back of his hand. He knows all the neighborhoods and he knows all the people there. City government people. He knows people in the local business community, all the agencies that are there. So that's what we do. We operate in these tertiary markets. We do really well. We have strong roots to the community and with all the agencies and the military and stuff. So yeah, I hope that answers your question.
Yeah, that was perfect. We're at 1 o'clock, so we're going to go ahead and wrap this thing up. Do you
Okay.
have contact information that you can share?
Yes,
Perfect.
I'm gonna type my email in here so
Okay.
you can. Our website is QilaCapital.com. Can I just type my information in the chat?
Yeah,
Perhaps people can just
you should be able to
post on
chat it to
panelists,
everybody.
or
Yeah, if you put it in the chat and then send it to everyone, they'll receive it.
I don't think this is going. It's only I don't have the option to send it to everybody.
Okay.
So if you can just forward it, please.
Yep.
So this is my contact info. Please reach out to me. I love to meet investors and I love to host investors. So if anybody wants to take a little weekend getaway and come visit us in San Antonio, we love to host you. We would love to put you at one of our properties, complimentary, obviously. Stay here for the weekend, explore the city. We'll give you a tour of our hotels. We'll show you what the hotel business looks like on the back end as well.
Awesome. This was fantastic. Any kind of closing remarks before we finish it off?
No, I'm very happy to be here, Matt. Thank you so much to you and Camel You guys are awesome, and we really appreciate the opportunity. We're very passionate about what we do. We love what we do. I stay minutes away from all of our properties in San Antonio. I go there all the time. I even make surprise visits to make sure the people are doing their jobs right. So
All
we love what
right.
we do. We love to meet you, and we love to hop on a call, a coffee session, or meet you in person in San Antonio.
Great. And if we have you back on November, December, will that be a good timing for you to
Absolutely.
talk about the medical site fund?
Yeah.
All right.
Hopefully. And at the very least, I'll talk about the Westin because the Westin is gonna undergo a $15 million transformation. Oh, one more thing I want to mention. If anybody has Instagram, please follow me on Instagram because I post a lot of content now, and that's my biggest goal. I'll share that as well here. And we also have a YouTube channel. We're making a lot of content to show our investors what the business is like and what we're doing at our properties and stuff. And that's my handle right there on Instagram. So follow me, follow Qila Capital, and I hope to talk to you soon.
Awesome. So I shared the contact information. I shared your IG handle. Thank you very much, Raza. This was fantastic. Everyone who joined us as in the audience, thank you very much. Really appreciate you being here. We'll see you on the next one next week. Have a great day, and thank you again. Bye bye.
Thank you very much.